Hey guys, Tom here from the Investing with Tom YouTube channel. Welcome back to the channel. If you enjoyed today's video, hit like, hit subscribe, and that way you can see future videos as well. So there is a long-standing sort of investment saying out there that when there's blood on the street, buy houses. And there are a few sort of sectors of the stock market in particular where there's been a lot of blood spilt over the past 12 months. If you look at the airline stocks or the cruise liners or the hotel stocks or even some retail businesses, these are all companies that have had a really rough last 12 months. They've had to dramatically shrink their business. Many of them have borrowed a lot of money to stay alive. A lot of them have issued new shares to stay alive. And in this video, I want to talk about some of the factors that I'm considering when I personally look into these types of businesses. And I also want to give some examples of where, even though the stock price is actually down somewhat since last year for many of these stocks, they may actually not be any cheaper than they were pre-crisis 12 months ago. Now, before we get into that, we do have a sponsor for today's video, and today's sponsor is Hatch. Now, they have been a long-time sponsor of the YouTube channel at this point, and they are my personal broker of choice for doing all of my US investing from here in New Zealand. So I initially switched across to Hatch, as many of you probably know, purely because of fees. I was paying huge $90 US per trade brokerage fees previously with one of the big banks. It was really hard from New Zealand to access the US stock market, especially for small individual investors. Hatch have sort of broken down a lot of the barriers to entry, particularly on just purely the fees side. And that was really my main motivation for initially switching across to Hatch. And one of the things that Hatch have been doing for the close to 2 years now that I've been a Hatch customer personally is basically just continue improving the platform. They are now coming out with kids accounts. They have actually launched those just in the last couple of days, kind of behind the scenes, and they're going to go public with that on the 1st of March to spread that information more widely. And kids accounts are a great way to, as the name suggests, set up an account for your kid. And it's set up in a way where the costs are very, very low. So you can invest small amounts of money. Fees are as low as 50 US cents per trade. There's no ongoing subscription fees or anything like that. So, you know, if you buy shares today and your kids have them in their accounts for 20 years, that's all you ever pay is the 50 cents up front. And it's a great way to get compounding working on your side and started early in order to have that money compound really well over a long period of time with no frictional costs right the way through. So if you're interested in getting started with Hatch or checking out the kids accounts as well, I will leave a kids accounts link down in the description below. But to get started with Hatch in the first place, you'll need to go to the link hatch.as/investingwithtom. If you click on that link, sign up and start a new Hatch account and deposit 100 New Zealand dollars into that account, Hatch will actually give you a free $20 top up so that you can get started investing with a little bit more cash. Okay, so let's get into talking about the recovery stocks as they're called. This video is not intended to be something that tells you to go out and buy these stocks or sell these stocks. It's just kind of me funneling some thoughts that I've got into my head into this camera and onto YouTube in order to maybe give you a few more things to consider if these are businesses that you're looking at putting your hard-earned money to work with. So a few things that have happened broadly to a lot of these businesses. So many of the companies that are sort of in this recovery stock kind of sector, things like airlines, things like cruise ships, things like hotels and resorts, all of these businesses have quite a few sort of common characteristics of how those companies run, as well as some of the things that they've had to do in order to survive over the past 12 months. And at the very, very top of that list are two things. Firstly, taking on debt and issuing shares. And basically, both of those things are sort of borrowing from your future self. If you take on $1 million in debt, for example, that is money that you're going to have to pay back at some point in the future, and you're sort of detracting from, your future self's positive cash flows because you're going to have to put some money towards that $1 million that's constantly getting paid back. And in Warren Buffett's words, basically, you're $1 million worse off if you have to take on that debt in order to survive, and that money sort of disappears into keeping the business going. So that's the first thing that many of these companies have done, is simply take on a lot of debt. The second thing is issue shares. And effectively, issuing shares has the effect of diluting your ownership in a business. It's the exact opposite of a share buyback. Basically, what happens is you have a business, it's cut into many little pieces called shares, and if you issue new shares, basically what you're doing is you're cutting that business into even more smaller and smaller pieces. So the people that had shares that represented, a small piece of ownership in that business initially now have those same number of shares, but there's more shares in circulation, there's more pieces of the pie. So each individual share now actually represents less ownership in the company. And there are some companies that do share issuance really well and do share buybacks really well. A common theme with a lot of these particular recovery stocks is they were having to issue shares at the absolute worst possible time. Ideally, you want to be issuing shares when your stock is really high and really overvalued. Unfortunately, many of these stocks were having to issue shares when, the business price, the share price was at multi-year lows. And basically what that means is every share that you issue, you get a pretty small amount of cash injected into the business relative to what you might have been able to get when the share price was high. And that has the effect that, if you need $1 billion in cash from issuing shares, if you've got to do it at a really low share price, it means you have to issue more shares than you would have had to at a higher share price, and there's just more overall dilution for shareholders. But that's not to say that many of these businesses won't get on track and, return to profitability and so on, but there are going to be a few more things that you have to be aware of. And towards the end of the video, I want to spend a little bit of time talking about how all this issuing shares and taking on debt and so on impacts valuation. We'll get to that at sort of the towards the tail end of the video. But the next thing I want to talk about is a concept of operational leverage. Now, this is again something that tends to be fairly common in a lot of these companies. Many of these companies have huge, what you'd call fixed costs, basically costs that they have to pay regardless of how well the business is doing. It's not like when you make some sort of widget and sell it. If you make less widgets, you have less costs, and you can kind of scale the profitability of the business up or down with how many sales you have. Many of these businesses, like airlines, for example, have a lot of fixed costs. So, they have airlines sitting on the tarmac that even if they're not being used, they're having to pay, money towards to keep that asset kind of there within the business all the time. If you're that airline company and you have less flights going around, sure, you're going to save money on things like staff and things like fuel, but you're still going to have a lot of costs for a lot of planes that are just sitting on the tarmac doing absolutely nothing. And that is operational leverage. Basically what it's saying is that in order for these airline businesses or the cruise line businesses or the hotels and resorts, any kind of asset heavy business really, it's usually the type of business where you have to have a lot of revenue in order to make a small amount of profit, a small amount of cash flows. And essentially those cash flows are generally just being generated from the very last bit of revenue that comes in. You've got a lot of upfront costs that you have to cover with revenue. Then it's sort of, the last 5-10% of that revenue that really generates the cash flows, the profits. So anytime some of these businesses have, a small dip in revenue, they can actually have a substantially larger dip in their earnings and their profitability. And a lot of these businesses have actually had quite substantial drops in revenue, which is the reason that these companies suddenly go from earning modest profits to some earning no profits at all, and to many of them actually going backwards at quite a rate of knots. Okay, so let's talk about valuations. If we look at the stock price of many of these particular companies, the share price is a lot lower than it was 12 months ago, and that to a lot of people would suggest that these stocks are now on sale, they're at a discount. But are they really? That's what I want to kind of dive into. We have to consider other factors. We have to consider that they've taken on debt and issued a lot of shares before we actually come to that conclusion about whether they are cheaper or not, because it's not as simple, unfortunately, as just looking at a stock price and saying, it was 50% higher 12 months ago, so it must be at a discount and that sort of thing. So something I want to reference quite a bit through this valuation part of the video is the concept of enterprise value. So I've talked about enterprise value in some of my other videos, but I just want to give a very quick kind of simple example that really clears this enterprise value concept up in my head. So often we're going to be comparing enterprise value to market cap. Now, many of you will be familiar with market cap. That's basically if you buy all the shares of the entire company, that total dollar figure is equal to the market cap. The enterprise value is that market cap number plus any debt or minus any cash that might also happen to be on the company's balance sheet. Now that's a nice definition, but how do we actually think about that practically? Basically, I like to take the example of a real estate investment. Let's say you went and purchased a home, purchased a house, and let's say that house cost you $1 million. Now, if you paid entirely cash for that property and the asset value was $1 million, you paid $1 million in cash for it, you took on no debt, then that would mean that both the market cap is $1 million because that's sort of your equity in the home, and the enterprise value is also $1 million because that's sort of the overall value of the asset. We don't have to adjust for cash or debt or anything like that. Now, let's take that same home again, but let's say you only put $500,000 down. The house is still worth $1 million, but you also had to borrow an additional $500,000 to, make that purchase happen. So you've put down 500 grand, you've borrowed 500 grand, and you've purchased $1 million asset. Now, in that case, the asset overall is still worth $1 million, and that in this case is what I would refer to as the enterprise value. The value of that sort of profit engine, which is this rental house that you've purchased, is still $1 million. But the market cap or your equity in that house is only $500,000. If we actually went and listed this house with the $500,000 in debt that's worth $1 million on the stock exchange, and that was priced efficiently, it was priced rationally, then that house, that stock that we've now listed on the stock exchange, would have a market cap of $500,000 because that's what you're doing when you're buying shares, is you're buying the equity, but it would have an enterprise value of $1 million because that's the value of the asset, and we've got the market cap plus the $500,000 in debt gives us our $1 million, which is equal to the asset value of that property. So let's now apply that same thinking to some of these recovery stocks, to the airline businesses, the cruise lines, the hotels and resorts, and let's see how this sort of enterprise value versus market cap kind of dynamic is going on. Now, if we look at a business like American Airlines, for example, this is a super interesting case study. So the stock price for American Airlines from the highs, pre-crisis to today, the stock's down about 30% roughly, something like 29% maybe. But the really, really interesting thing is that the enterprise value for American Airlines is actually higher than it was pre-crisis. And to me, this is an example of, we're looking at the price of a stock versus, the underlying value isn't as simple as just seeing that the stock price is down versus last year. Now, yes, you're paying a lower share price. Yes, you're paying a lower market cap, but you're actually paying a higher valuation for the business in enterprise value terms than you were pre-crisis. And to me, when you're looking at a stock that has gone through huge turbulence, the business is really struggling, and we're probably realistically a few years from getting fully back on track with travel worldwide and all that sort of stuff. We can argue about that stuff all day long, but nonetheless, the business is in worse shape than it was 12 months to 2 years ago. Yet people are willing to pay more for the assets of the business than they were pre-crisis. And that is something that makes absolutely no sense whatsoever to me. And we continue to see the same thing with many other stocks. If we look at a company like Carnival Cruise Lines, for example, the stock is down close to 50% from the highs last year, yet the enterprise value is almost the same as it was, pre-crisis. So people are still willing to pay the same sort of valuation for the business if you incorporate the debt that CCL have taken on. And again, that just doesn't make any sense to me whatsoever. The business is certainly in worse shape than it was 12 to 24 months ago, yet people are willing to pay the same valuation on sort of the assets, the earning power of the assets through the enterprise value. They're willing to pay the same amount that they were pre-crisis, and that just makes no sense to me at all. And I'll put up some other examples of stocks here that have had a similar thing happen with the enterprise value. The Ford Motor Company is another good example. Also something like Wynn Resorts is another good example. These are both stocks where the enterprise value is basically the same or even higher than it was pre-crisis. And when you factor in the debt that these businesses have taken on, I think that's kind of not a rational way to price some of these companies. So that's not to say these stocks will do well or will do poorly, but they're interesting observations from me, and it's something that I will watch with interest from the sidelines with many of these stocks. So that hopefully gives you a good idea on the differences between enterprise value and market cap, and how some of the debt and share issuance and so on can impact the valuations that are actually maybe a little bit higher than you might have first thought by just looking at a regular share price. But the last thing I want to get into is just leverage in general and how that can actually impact the volatility of the share price of many of these businesses. So again, if we go back to the thing that I've been blabbing on about right through this video, many of these companies have a lot more debt than they did 12 months or 2 years ago. So that inherently makes the equity that you're purchasing when you buy shares, you're buying equity in the company, that inherently makes your equity potentially a lot more volatile. And as a value investor, as someone that's looking to capture a large difference between intrinsic value and the price and trying to buy at a discount to intrinsic value and so on, volatility is actually a good thing. That's something that I really like. If the intrinsic value of a stock is at sort of one point and the market price of that stock sort of fluctuates wildly around that creates opportunity to buy at a discount and sell at a premium and so on. So volatility in and of itself is not necessarily a bad thing. Volatility due to a lot of leverage can be kind of dangerous, because leverage is one of the few things that can really kill a company. But it also creates volatility in share price, and that's for the basic reason that I will relate back to our original sort of $1 million home example to kind of explain why that happens. So let's again take our $1 million home, and let's say that we've still got 500 grand in equity and 500 grand in a mortgage and debt. Now, what happens if the market then goes on to price that asset, let's say 50% higher than it did initially? Let's say we're now 5 years down the track, and let's just assume for argument's sake we haven't paid off any debt in that time. Let's say we're 5 years down the track and the asset value of that $1 million home has now gone to $1.5 million. Now, we still have our $500,000 in debt, so if we've got an asset worth 1.5 and we've got 0.5 in debt, we now have equity of $1 million. So our equity has gone from 500,000 to $1 million because we've got leverage. We've got an asset value that's gone up 50%, yet our equity has gone up 100%. And that is the power of leverage when it works in the right direction. And the exact same thing applies for many of these businesses. If the stock market, if Mr. Market comes out and decides that they want to price the value of these enterprises a little bit differently, then the value of the equity, the market cap, will tend to move up or down a lot more dramatically than sort of the re-rating that happens on the enterprise value. So let's take that same example and let's take our $1 million home and say that there's a massive crash in the housing market, and the value of that asset goes from $1 million to $500,000. Now, the asset value has gone down 50%, the enterprise value in this case, and the equity has gone from $500,000 to zero, because we've got a $500,000 asset and we've got $500,000 in debt, which leaves us zero equity kind of in the middle. And really, that is a reason that creates a lot of volatility in highly leveraged stocks. We've got a thin slice of equity with a lot of debt around it. So anytime that the value of the asset or the enterprise moves up or down, we tend to get much larger swings in the share price and in the market cap of that company. So that's my 2 cents on recovery stocks. It's not to say that they'll do poorly or they'll do well. It's just kind of a few things to keep an eye on if you are looking into any of these businesses. So the sort of high level highlights, the bit of a summary from that video is that many of these companies have taken on a lot of debt, and many of them have also issued a lot of shares. A lot of them have operational leverage, so they're really going to have to get to place in time where the business is absolutely cranking again in order to produce good profits. The extra debt and extra shares that have been issued do genuinely impact enterprise value versus market cap, and that discrepancy quite a bit. And many of these stocks may not be as cheap as they maybe first appear when you just look on a simple share price basis. And also, many of these companies, I expect at least, will have quite volatile share prices over the next few years because they are now highly levered entities, or at least much more levered than they were just a couple of years ago. So that's it from me today. I do hope you enjoyed the video. If you're interested in the Hatch offer, head to the link hatch.as/investingwithtom. But that's all from me today, and I will see you in the next one. Cheers.